What if I told you that two Canadians could invest in the exact same ETF, the exact same stock, for the exact same amount of time, and end up with completely different amounts of money? Not because they chose different investments, but because they chose different accounts. One of the biggest mistakes new investors make is not spending enough time understanding the type of investment accounts. And that can actually have major tax consequences over time. So in this video, I'm going to break down the most important investment accounts every Canadian should know, how they work, and when they generally make the most sense. So account number one, the TFSA. The TFSA is very important. Many people in Canada consider the TFSA as the most powerful investment account in Canada. As a recap, the TFSA is called the tax-free savings account. So inside this account, you can hold stocks, ETFs, REITs, mutual funds, GICs, and bonds. The biggest advantage of this account is that the growth inside is generally tax-free. So what that means is that the capital gains, the dividends, and the interest income is tax-free. That's why the TFSA is often the first account many Canadians prioritize. So next is the FHSA, or the First Home Savings Account. This account was introduced to help Canadians save for their first home. So what makes this account very unique is that it actually combines some of the best features of both the TFSA and RRSP in one. So what this means is that you may receive tax deductions when contributing and potentially tax-free withdrawals when purchasing and qualifying for your first home. Many financial professionals consider this one as one of the most attractive accounts available for first-time home buyers. So if you're looking to buy a home someday, this account is worth understanding. So account number three is the RRSP. So the RRSP stands for the Registered Retirement Savings Plan. So what the RRSP is that it's an investment vehicle for retirement planning. The major advantage is that contributions may reduce your taxable income today. So let's put that into perspective. So if you're in a higher tax bracket and contribute to your RRSP, you may receive a tax refund or a tax deduction. However, there is a trade-off. Withdrawals are generally taxable in the future. Think of the RRSP as pay taxes later kind of account. Think of the TFSA as potentially avoiding taxes on growth altogether. So with that being said, for many Canadians, the RRSP becomes increasingly valuable as income rises. Account number four is non-registered account. So the non-registered account is sometimes called a cash account. So this is actually the standard investment account, unlike the TFSA, RRSP, and the FHSA. There are generally no contribution limits on this account. So for an example, you can invest as much as you would like. However, there is a downside though. Investment income may be taxable. So this all includes capital gains, dividends, interest income, etc. Essentially, many investors use non-registered accounts after maximizing their registered accounts. So the registered accounts are the ones that I named before, the TFSA, FHSA, and RRSP. So we're going to be looking at account number five, which is the margin account. So what a margin account is that it allows investors to borrow money against their investments. This ultimately creates leverage. What leverage is that it can increase gains, but also it can increase losses as well. Margin accounts are generally more advanced and require a solid understanding of risk management. So for beginner investors, I usually recommend learning the fundamentals first before considering any kind of margin investing. Okay, so we're going to be looking at account number six, which is the RESP, or the Registered Education Savings Plan. This account is designed to help families save for a child's education. One major advantage is that the Canadian government may contribute grants to eligible accounts. So this means that any additional money can potentially be added towards future education expenses. So if you have children or plan to have children, the RESP is worth exploring. So many people may ask as to which account they should prioritize, and the answer depends on your goals. So if you're eligible for an FHSA and plan to buy your first home, many investors start there. If your goal is long-term tax-free investing, the TFSA is often attractive. If you're focused on retirement and reducing taxable income, the RRSP may make sense. If you've maxed out all of your registered accounts, a non-registered account may be the next step. And if you're an experienced investor who understands leverage, a margin account may be your strategy. So the key takeaway for today's video is that the account does matter, not only the investment. The truth is that people spend many years looking for the perfect stock, the perfect ETF, the perfect investment, but unfortunately they don't take time out to understand the perfect account for their investment strategy or their investment goal. They completely overlook the account they are using because taxes does matter. Account structure matters. And understanding these accounts can potentially help you keep more of your money working for you over the long term, as opposed to working against you. So before you worry about finding the next great investment, make sure you're investing through the right account. Because wealth building isn't just about what you invest in, it's also about where you invest. If you found this video helpful, make sure to like, subscribe, and continue investing in your financial future. Because the more you understand how money works, the more empowered you'll be to build long-term wealth, financial freedom, and a future on your own terms.